if you close your eyes.
First and foremost, I want to thank all of you for joining me today. In this video, I'm going to be covering the basics of how I made over $1,000 by making short-term trades and by using covered call options. And to answer your feelings of distrust rather quickly, yes, I actually made this much money, and no, this is not clickbait. I do want to clarify, however, that there are a few minor details such as fees and other costs that are associated with some of the trades that I made. However, I'll be covering those individually as I go through each transaction. My hope is that as I go through each individual transaction, you will grasp a better understanding of what it takes to evaluate a company and place successful long and short-term trades. Along with this, my hope is that you come to an understanding of how covered call options can be useful in different types of situations. With that, let's take a look at each transaction in a little more detail. The first thing to notice before we get into too much detail is that throughout the course of each transaction, I'm trading a company called SuperValu Incorporated, and they have the ticker SVU as seen to the left of your screen. SuperValu operates as a grocery wholesaler and retailer in the United States, which means they are actually involved in operating grocery stores like the ones that you and I can walk into and buy food at, and they're also involved in selling products to grocery stores like County Market. The next thing to notice is that the day I bought and sold my shares is the exact same. The reason being for this is that 1/11/17, the day after I purchased my shares, SuperValu was releasing their third quarter 2017 earnings report. I won't go into too much detail here for the sake of time and complexity, but generally a company's stock price begins trending upward several days prior to an earnings release. However, generally this uptrend is met with a pullback once the earnings are actually made public. For more detailed information on this topic, check out the link within the description. As seen on the screen, the first trade I placed was just over $4,000. On this particular transaction, I held for just over 3 hours and sold for a total of $4,216. Taking into consideration the different fees associated with this trade, this brought my total profit to just a little over $121. Not bad.
If that's your girl, why she in my section? If that's your girl, why she doing role play?
In transaction 2, again, one of the first things we want to look at is the date of the initial transaction. 1/13/17 is 2 days after earnings, and if you remember from transaction 1, it is the date that my funds settled back into my account. In plain English, what this means is that on 1/13/17, I was allowed by my broker to place another trade. The main reason why I placed another trade on 1/13/17 was because earnings disappointed, causing the stock price to fall, and I felt that there was a modest overreaction in the market. Being able to sense this type of thing comes from experience in trading, but also comes from something that has nothing to do with the stock market at all, which is being able to understand people, conceptualizing how they are likely to behave, and then making predictions off of that perceived behavior. Those who know me personally know that I'm not a psychology major, but the advantage that I have is taking the time to read books that discuss human behavior and how that behavior is likely to affect the market. 2 books that I recommend that will allow you to understand the relationship between people and markets more easily are The Wisdom of Crowds and The Alchemy of Finance. Details on both books can be found by visiting my website located in the description. As seen in the transaction details, on 1/13/17, I placed a trade for just a little over $4,200 and then sold my entire lot of shares 4 days later for right at $4,400. Adjusting for fees associated with the transaction, this trade landed me a profit of around $162.
Everything I see up in my head just comes to life. Got my favorite girl.
This transaction is very important and is listed as part of 3 and 4 because without it, transactions 3 and 4 would definitely not have happened. I would definitely consider this particular transaction one of my biggest mistakes to date, but without it, I wouldn't have had the opportunity to understand the value of a covered call option. In this transaction, it's very important to understand that I purchased more shares of SuperValu on January 20th, 2017. Along with this, it's important to key on the number of shares that were purchased, the price that those shares were purchased at, and the total cost of the transaction. The other thing to key on is this: don't get greedy. As I mentioned, this is one of my biggest mistakes to date. In pursuing profits on this company, I completely lost sight of why I was even investing in them. Even though I've mentioned to you guys that I've made a lot of money on this stock, the situation that I'm in is definitely not ideal due to the fact that I no longer maintain control over my shares. Of course, I'm going to explain this to you in much more detail in the next two transactions.
I'm not perfect, but for you, I do pretend. I've been working 2 to 10. That's saying.
Transaction 3 is somewhat complex, so before I go into any detail, I want to mention that if you visit my website that's in the description, there's a much more detailed article about all of this that I'm talking about to help you better conceptualize these things if you're having trouble understanding. For transaction 3, we must go back and remember the previous transaction where I purchased 1,020 shares of SuperValu for nearly $4,400. I told you guys that I learned the hard way not to get greedy trading, because soon after this transaction, there was a big price drop. So big, in fact, that if I were to have sold all of my shares, I would have lost over $1,000. Okay, so in order to gain some sort of return and allow myself to maintain some liquidity, I had to sell a covered call option. Again, I'm going to spare you guys some detail due to time and complexity, but essentially what the covered call option did was gave someone else control over my 1,000 shares. In order to maintain control over these shares, the person had to pay me a premium of $180, which gave them a time frame of about 6 months to decide what they wanted to do with them. If no decision was made in the 6-month time span, I still got to keep the $180 and I got back control over all of my shares, which is exactly what happened. However, if you're familiar with options at all, you know that during that time span, the person I sold the contract to could have exercised the option and could have purchased the shares from me for $4.50 per share. Remember, as the arrow is showing, I originally purchased the shares for $4.29 per share. This means that if at any time during that 6 months the option would have been exercised, I would have received the premium and an extra 21 cents for every share I owned. Just a reminder, this did not happen. The option expired and I made $180 on the deal. Many of you may be scratching your heads right now and wondering what sort of language I was just speaking. As I mentioned, if you're one of these people and you're interested in learning more about this topic, check out my website in the description.
You ready? Girls these days.
Transaction 4 is essentially the same thing as Transaction 3. There's a whole lot of extra stuff associated with this transaction, so for this video, let's just focus on the portion that matters. As with Transaction 3, in Transaction 4 I sold another call option. However, the premium was much greater on this one, stretching more than $600. The reason for this is simple. Rather than relinquishing control of my shares for 6 months, I have relinquished control for over a year. Not having control for this much time, along with a lower strike price, requires a much larger premium from the buyer. You may have also noticed that the strike price is lower than the $4.29 that I originally paid for my shares. So in plain English, what this means is that I will lose money if this option is exercised. But the loss will be minimal compared to the premium I have received and the other money I have made on my prior short-term trades. This option has not exercised yet and is quite a ways away from expiring, so I'll keep you updated on how the transaction ends. As a reminder, no matter what happens, I still get to keep the $600 premium. I have one last thought. Many of you may be wondering why I would give up control of my shares for over a year, which is definitely a rational question. And here's my answer. The probability of the option getting exercised in the next year is extremely high. Rather than waiting months for the liquidity, I was able to sell this option and take over $600 in cash right now and invest it back into the market for a return. Along with this, when the option does exercise, I will finally be able to fully liquidate my position in SuperValu without taking a loss on the initial investment because of the high premium. Obviously, there were many more calculations and many more complex thoughts that went into this decision, but that's my best simple answer. Hey guys, if you haven't already, make sure you hit that subscribe button down below if you want to get updates every time we post a video like this, and check out the links in the description to hit up our website and subscribe to our monthly newsletter for your shot to win a free t-shirt. Thanks for watching.
Trust me, I just lead the way. Hop up 3 times before 3 today. Piece of cake. Never gave a f about what the teachers say.